encima del 6,29%. En cualquier caso, dos palabras, 14 letras, las que catalizan al mercado, las que tiene el ojo puesto el inversor durante toda la jornada de hoy. Reserva Federal, mañana toca Banco Central Europeo. Jay Pelosky, TPW Advisory Founder. ¿Qué tal? Muy buenas tardes. Good afternoon.
Hi, good afternoon.
Will the Fed pause in its decision this afternoon? CPI and PPI seem to be reasons to justify such a decision.
Yes, we expect the Fed to be on hold, and we expect that to actually be kind of a long-term hold. What's interesting is that while the market is expecting the Fed to pause today, there's still, the market is pricing in a 70% chance of a rate hike next month in July. We think that's not going to happen. And more importantly, even than the decision on the rate side, we believe is going to be the update on the Fed's outlook for the economy. And we expect the Fed to significantly increase, perhaps double its 2023 GDP estimate. And we think that's what's really driving risk assets, is the market starting to price in the reality of no recession. And you see that in terms of the cyclical sectors really starting to work within the U.S. equity market.
Okay, Jay, after the latest inflation data, we have seen that car sales, for example, in the U.S. are worse than in 28. Micro indicators are telling us that the U.S. is in recession?
No, we absolutely disagree with the idea that the U.S. is in recession or is going into recession. We believe we're at the early stages of a global economic expansion, and would point out that the S&P Global Composite PMI for May, so global, was up at an 18-month high. So we believe Asia is leading the global economic recovery, with both China and Japan leading the way, the U.S. and Europe following. But no, we believe that the major factors which led to economic slowdown last year in the U.S., namely a housing crash, inventory destocking, and tech-related layoffs, have all bottomed. Housing has clearly bottomed in the United States. Housing stocks are up 20% off their low. We believe an inventory restocking is going to drive manufacturing higher in the second half of the year and into 2024. And obviously on the tech side, all anybody wants to talk about is AI, which is creating a lot of interest in the tech space, as we've seen with stocks. So no, we don't think the economy is going into recession. And we see even the bond market arguably pricing out the likelihood of recession, given how it has now taken out all the rate cuts that 6 weeks ago, 8 weeks ago, the bond market had priced in 75 basis points of cuts in 2023. Those are now gone. The Fed fund futures at year end is now about 5.1%. So effectively, the bond market is telling you that there's not going to be a recession, that the Fed is not going to cut rates, and we're going to be on an extended hold through the end of the year, which has been our view at TPW Advisory, consistently has been our view for the last 6 months or so.
What can we expect from the next meeting?
I think the Fed will continue to be on hold. We'll get the June inflation report before the July Fed meeting, much as we got yesterday's inflation report before today's Fed meeting. And the year-over-year comparisons are very, very favorable. Inflation in June of last year was 1.2%. It's going to be replaced by 0.3%. So we expect the headline inflation number in the U.S. Next month to fall under 4%. So we're very close to where the Fed wants to get to, and therefore the Fed is going to go on hold, as I said, we think through into 2024. And as we think about the world in the investment world, because really at the end of the day, right, it's all about what does it mean for financial assets, is a Fed on hold equals US dollar weakness, which equals rest of the world equity outperformance, as well as an opportunity for commodity prices to move higher. And we're starting to see the former in terms of non-US equities, particularly emerging markets, are really starting to move, particularly in Latin America. And we expect that to continue. We think emerging markets will start the next cycle, which is going to be a rate cut cycle. So we're done globally pretty much with the rate hiking cycle, and we're about to start probably in the next couple of months a rate cutting cycle, but importantly led by the emerging market central banks. And so we think that continues to be supportive of global growth, and we think that should be supportive of commodities. And so, you know, we note on a day like today that copper miners are up about 3.5%. So there's real opportunity, we think, in emerging market equities, in emerging market fixed income, and in the commodity space.
China, for example, as an emerging market?
Yes, we're quite keen on Mexico, which we believe is the world's winner from the regionalization of supply chains, which is taking place. So Mexico is receiving significant amounts of foreign direct investment as plants shift to the United States for electric vehicles, for batteries in electric vehicles, for semiconductor fabrication plants. Mexico is a huge beneficiary of this nearshoring or friendshoring. We also have a good-sized position in Brazil. Brazil, we think, is going to be among the leaders on the rate cut front. To give you an illustration, inflation in Brazil is running at about 4 to 5%, yet short-term government bonds in Brazil yield 13%. So we expect about 400 to 500 basis points of rate cuts in Brazil over the next year. So that should be that's a market we like a lot. It's also very commodity heavy. And then in addition, obviously there's China. And we expect the second half of the year in China to be better for Chinese risk assets. That equity market has been a disappointment to many, including us, so far year to date. But we think the second half of the year is going to be better. There's going to be some government support. The economy is growing at 5% or so, and we expect consumer confidence, which is still quite depressed in China, given that they only came out of zero COVID, 6 months ago. We think there's an opportunity for consumer confidence to continue to improve in China, and that should include confidence towards the stock market there. So China is obviously in emerging markets, it's 50% of the index. So when you speak about emerging market equity, China is an important component. And then lastly, local currency government bonds in emerging markets, we think is a real opportunity. It's one of our biggest, if not the biggest, fixed income position we currently have in our global multi-asset model is emerging market local currency debt. Again, rate cuts, weak dollar, all those things should support local currency emerging market debt.
Jay Pelosky, TPW Advisory Founder, thank you so much for being at Negocios Television. It's been a pleasure.
It's always a pleasure to be with you. Thank you.
Bueno, nos comentaba Jay cómo China es una oportunidad en los mercados emergentes, cómo va a haber recuperación, al menos en lo que se confía de cara a la segunda mitad de ejercicio para este gigante asiático, y cómo en los emergentes Brasil será uno de los mercados en los que empezarán a recortar los tipos de interés. Sobre si Estados Unidos está en recesión o no, porque hay indicadores micro que así al menos lo están dejando probar sobre la mesa. Es, por ejemplo, esas ventas de coches. Pues bien, dice Jay Pelosky que no, que Estados Unidos no está ni mucho menos en una recesión económica, que Asia, bien es verdad, es la que lidera el crecimiento económico, China, Japón, pero que Estados Unidos no está ni mucho menos en una recesión. No lo demuestran los datos macro, tampoco lo hacen los datos micro, en opinión de Jay Pelosky. Por cierto, que sobre qué va a pasar con la Reserva Federal, pausa ahora y no habrá cambio de calendario, al menos a lo largo del mes de julio. Eso sí, dice, no tanto el foco va a tener que estar en los tipos de interés, sino más en el outlook, en lo que vea que va a pasar la Reserva Federal, en cuáles sean las estimaciones de crecimiento económico del Banco Central estadounidense para lo que queda de ejercicio. Nosotros, publicidad y seguimos.